The showdown in the gold price that we predicted last year has come to pass. The gold price broke through its long-term resistance and soared to unprecedented heights. What is remarkable is that this breakout occurred during an environment in which, according to the previous playbook, the gold price should actually have fallen. The collapse of the correlation between the gold price and real interest rates raises many questions. To better illustrate this trend, the rising real interest rate, represented by the blue line on this chart, is inverted. In the old paradigm, it was unthinkable that the gold price would trend firmer during a phase of sharply rising real interest rates. This long-time pattern is not the only one that can no longer be used to explain the gold price trend. There is considerable evidence that the old set of rules has become outdated in essential aspects, indicating that it is time to adopt the new gold playbook. The rules of the gold game are changing on many levels. That's why we want to take an in-depth look at the global upheavals in this 18th edition of the In Gold We Trust report and introduce you to the new gold playbook. Before looking at the charts, we would like to express our profound gratitude to our premium partners for supporting the In Gold We Trust 2024 report. You can find more information on their services through the link in the description. The picture in the West contrasts sharply with that in the emerging markets. The once strong link between investor demand from the West and the gold price has dissolved in recent quarters. Despite gold's record run, ETFs, which are primarily used by Western financial investors, have seen a net outflow of around 760 tons of gold since April 2022. According to the old gold playbook, gold should be at around $1,700 given the fall in ETF holdings. A key element of the new playbook is that Western financial investors are no longer the marginal buyers or sellers of gold. Significant demand from central banks and private Asian investors has driven gold prices higher, even amidst rising real interest rates. Among the central banks, the People's Bank of China in particular is continuously expanding its gold reserves. Purchases have been registered for 18 months in a row. The chart shows the low point of gold prices in 2022, coinciding with the acceleration of Chinese central bank purchases. These uncertainty factors, combined with continued high liquidity, the Chinese population's cash holdings are at a record high, create superior conditions for investing in gold. Any remnants of fiscal sanity were finally thrown overboard by Western countries as part of COVID-19 policy. This monetary climate change, as we called it in 2021, is still in full swing and has by no means reversed even after the end of the pandemic. In addition to costly initiatives such as the Inflation Reduction Act, the Green New Deal, and the sharp rise in spending on a social system that is structurally underfunded as a result of the demographic situation, there is now also the need to cope with the financing of military rearmament. Compared to fourth quarter 2019, the eve of the COVID-19 pandemic, U.S. debt has risen by $11 trillion or around 50%, and there seems to be no end in sight to the debt binge. The abandonment of fiscal discipline by Western countries during the COVID-19 pandemic continues to impact the economic landscape as the fiscal nonchalance persists despite sharply rising interest rates, making debt servicing increasingly costly. However, this budgetary irresponsibility is now taking place in an environment of sharply rising interest rates and no longer one of low or even negative interest rates. As a result, around 10 times as much had to be spent on interest payments for German federal debt in 2023 than in 2021. This trend was covered in our book, The Zero Interest Rate Trap, which gives great detail of the economic and social consequences of interest rates that are at or even below zero. For more information on the book, see the link in the description. Even if never session and no landing are now the consensus view on economic development in the U.S., we remain suspicious of the various Goldilocks and landing scenarios. After all, history shows that tightening cycles have almost always ended in a recession. The playbook has also changed on the central bank policy side. The world's central banks appear to have an increasingly asymmetrical view of inflation. After inflation rose above 2% in 2021, the Federal Reserve hesitated for a whole year due to its misjudgment that inflation was merely transitory. By contrast, according to the FOMC minutes of March 2024, The Federal Reserve intends to cut interest rates 3 times this year, even though inflation has not yet fallen to the 2% target. It is obvious that this pro-inflation bias of the central banks can also be explained by the continuing rise in debt levels and the marked increase in financing costs, even if the central banks are careful not to answer any questions about the sustainability of the debt burden under the guise of maintaining an apolitical stance. The age of the great moderation is over has been a central message of our keynotes and studies in recent years. Due to the increasing fiscal dominance, it is unlikely that the monetary authorities will be able to consistently combat inflation. We continue to expect structurally higher inflation rates and persistently high inflation volatility. The last few months have shown just how persistent inflation can be. Looking back at the 3 waves of inflation in the late 1960s and 1970s, the similarity to the current development is indeed striking. Even if history never repeats itself one-to-one, another wave of inflation is definitely within the realm of possibility. Because Western financial investors in particular have not yet realized that there is a new version of the gold playbook, gold remains on everyone's lips but is far from being in all portfolios. The low affinity for gold among large sections of the investment community was recently confirmed by a Bank of America study. In fact, 71% of U.S. advisors have little to no gold allocation, meaning it is less than 1% of their portfolio. We analyzed the effects of different gold allocations in an equity bond portfolio. The study period extends from 1970 to 2024 and includes monthly data on gold, as well as the total return indices of the S&P 500 and 10-year U.S. government bonds in U.S. dollars. Our calculations show that the integration of gold into an equity bond portfolio has a clearly positive impact on the Sharpe ratio. The optimum is achieved in an allocation range of 14 to 18%. Silver can also play a significant role as performance gold. Silver is experiencing a supply deficit for the 4th consecutive year and has outperformed gold in 6 of the last 7 bull markets since 1967. Historically, it was increased investment demand that was decisive for pronounced silver bull markets. In the event of a second wave of inflation, a wave of FOMO could set in, and silver would probably be one of the biggest beneficiaries. The gold mining sector is unique in many respects. While fundamental bottom-up research is essential for careful stock selection and sensible diversification, macro-specific top-down influences play a particularly important role. As far as sensitivity to monetary policy is concerned, a look at the past shows that investment times around the last interest rate hike have usually been excellent entry points. Due to the historical undervaluation of the mining sector, in mid-February 2024, we launched an investment strategy focusing on gold, which takes into account these important top-down factors and other ideas of the new gold playbook. The Incrementum active aurum signal presented in this In Gold We Trust report plays a central role in the investment strategy. This signal examines when it is advisable to acquire performance gold in the form of mining stocks in order to increase the gold beta. It also determines when it is appropriate to take a more defensive approach to gold exposure and provides a clear buy or sell recommendation through 3 levels: offensive, neutral, and defensive. When comparing the performance of an active gold mining stock strategy using our Incrementum active aurum signal to a passive strategy of being 100% invested in gold mining stocks, the results speak for themselves. While a passive strategy has achieved a performance of around 470% since 1971, our Incrementum active aurum signal strategy achieved a performance of over 7,000%. Further information on the strategy can be found at www.incrementum.li. The commodity supercycle, which we have regularly pointed out in recent years, has taken a breather, but in our opinion, it is still intact. Price increases and supply bottlenecks have brought a potential shortage of resources back into the public eye. Just recently, Nicolai Tangen, CEO of the $1.5 trillion Norwegian Sovereign Wealth Fund, warned of a possible shortage of resources and rising commodity prices. In view of the neglect in the CapEx cycle, which we described in detail in the In Gold We Trust Report 2023, we firmly believe that the commodity bull market is only in its early stages. Traditional portfolios are currently still characterized by a 60-40 mix of equities and bonds. A portfolio with a strategic asset allocation of this composition has undoubtedly been able to deliver attractive risk-adjusted returns in recent decades. However, the macro environment necessary for positive performance is history with the end of the Great Moderation. Around half a century ago, Harry Browne presented the permanent portfolio as an alternative to the conventional 60-40 portfolio. This is made up of 25% equities, 25% bonds, 25% cash, and 25% gold. Even though the permanent portfolio can still be an interesting alternative today, we believe that there is a more contemporary implementation within the framework of the New Gold Playbook. Our interpretation of a new 60-40 portfolio for long-term investors envisages a drastic reduction in allocations to bonds and an increase in non-inflatable assets. It involves a 60% allocation to stocks and bonds combined and a 40% allocation to various liquid alternative investments, namely safe haven gold in the form of physically stored gold, performance gold in the form of gold mining stocks and funds or silver, commodities and Bitcoin that we frequently refer to as digital gold. Of course, we do not see this allocation as a rule set in stone. Rather, it is intended as a guideline derived from the current monetary, fiscal, and geopolitical realities. In our view, the New Gold Playbook applies as long as we are in a phase of currency instability, characterized by high debt levels and geopolitical instability. A simple quantitative measure of currency stability are inflation rates. If average inflation rates remain below 3% over a 24-month period, this would be a good indication that the situation has stabilized. Until we return to stable monetary waters, a significant proportion of non-inflationary, default-proof hard currencies, real assets, and commodities in the portfolio seems advisable. Loyal readers will remember our gold price forecast model that we published in the In Gold We Trust Report 2020. At that time, we calculated a price target of just above $4,800 by the end of 2030, using the gold coverage ratio as a key input factor. In particular, the Federal Reserve's rigorous interest rate hikes and the temporary slowdown in inflation have kept the rise in the gold price in check over the past 2 years. The recent surge in the gold price is probably a harbinger of the imminent turnaround in interest rates and possibly also of an increasingly stagflationary environment in the U.S. We feel that the recent price action confirms our price target, and we continue to adhere to the target of around $4,800 for 2030 that we postulated at the beginning of the decade. If this price target sounds too ambitious to some readers, we would like to put the return derived from this target into historical perspective. Based on a current gold price of $2,300, this would mean a price increase of just under 12% per year by the end of the decade. By comparison, the gold price rose by over 14% per year in the 2000s and over 27% per year in the 1970s. For more information on the full gold report, visit www.ingoldwithtrust.report. And for those interested in an investment strategy centered around hard assets, visit our independent fund and asset management company, Incrementum. Both links can be found in the video description.